You think you're one great trade away from a massive win, right? Well, what if I told you you're also one common mistake away from devastating loss? There's a single error that equity draining thousands of dollars from your trading account every single week. It's toxic cocktail of fear and bad math. And today I'm gonna show you exactly what it is and how you can fix it for good. So let's be real. This isn't about a bad trade of some freak market event. This is call it a chronic disease in trading, a deep settled habit that costs aspiring traders their dream after years of spending time in the market and coaching and a hundred of traders. I've seen the pattern by plenty of you guys that many times cost a devastating loss in Blowing's account. Well, there isn't one single study to point it. It's widely said that the vast majority of trading mistakes come directly from emotional decisions, not bad analytics. It's just a quiet, call it the killer of trading accounts. The mistake is a two-part monster. First, emotional response, usually fear or greed, hijack your brain, then leads to a catastrophic technical errors. Flooded position sizing. You let your fill-in detect how much you are gonna put in risk, and that's the fastest way to blow your account that you worked for so many days, weeks, maybe sometimes years. Most traders think success is about finding the perfect entry. That's wrong. True, lasting success is about defense. Is about managing your risk so you can survive the losing trade, which is we'll call it inevitable. And still, there's two cash in the one of the winning sides. Today, we're gonna discuss this monster and arm you with some weapons to fight it back. So first. The first way this mistake gets you is basically the siren of songs of a life-changing trade. You know that the one, that one. A stock is going ballistic, a future contract going ballistic. It's all over the news. Social media is buzzing. The intense fear of missing out, the FOMO kicks in, and a powerful primal urge. You feel that you don't get it right here, right now, you're going to miss the ride of a lifetime. In that moment of panic and greed, your trading plan is out of the window. All those rules that you sworn you follow are now gone. You tell yourself this one is gonna make a difference. This one is basically my trade. This is the one. So instead of risking your standard 1 to 2% of your capital, you bet the whole farm. You go all in. You crank it up a little bit with a leverage, with a high risk exposure, and then you're getting terrified. You're not a trading at this point anymore. You just pull up the lever of a soul machine. You're gambling. And here is how to cost you thousands. Where when you bet big on a single emotional driven idea, you set yourself up for knockout or blow the account. The totally normal pullback is in the market becomes devastating loss for you because your position is way too big. One wrong move doesn't just erase your portfolio or your day; it can wipe up the whole month's. They can wipe up the whole the account of months of hard work. That single oversized FOMO trade is a huge reason why traders basically bleed thousands of dollars. So the solution is all about discipline and process. First, have a non-negotiable written trading plan. As I said many times before, you actually trust this plan must define your entry criteria, but most importantly, it has to define your risk before even you think about placing the trade. The 2% rule isn't just a suggestion, is your shield. You should almost never risk more than 2% of your total trading capital on one single trade. By mathematically locking your maximum loss before entry, you rip the emotion right out the window and out of the equation. You force yourself to treat trading like a business of probabilities, not a casino and a hope. The second way is basically to show or flow, the show up is call it a little bit sneakier, but it's but just as deadly. It's the illusion of safety you get from using a wide stop loss without adjusting your position size. A lot of traders learn that they need the stop loss to protect themselves, which is great. Of course, it's obvious, but then that makes a crucial error. They hate the feeling that they're getting stopped out of the trade, only to watch it to turn around and rocket in their favor. So to avoid setting that setting, they set their stop loss incredibly far away. It gives the trade some room to breathe, they says. The logic feels right, but catastrophic mistake is you don't just adjust your position size to the match. Risk isn't about call it the risk isn't just the distance to your stop loss. It's stop loss, a distance time your position size. A trader might think they are being safe with the wide stop, but if they still hold in a big position, they're actually sitting on a time bomb. A 10% move against you might seem unlikely, but a position makes up half of your account. That's 5% account loss, more than double what a professional obviously would risk. This creates a full sense of security when the loss finally hits. It's not a small paper cut, it's just a gaping wound. This is how a slow bleed of small mistakes suddenly turns into massive, horrible bleeding account that leaves you staring at the screen wondering what just happened. The solution here is pure as unbreakable math. You must always calculate your position size based on three things: your total account capital, the maximum risk per trade, like 1 to 2%, and the distance from your entry to your stop loss. The formula would be position size equal the total account capital multiple the percentage of rates dividing the entry price minus the stop loss. Let's walk it through. Say you have a $20,000 account and you committed to never risk more than 2% of the trade. That means that your maximum dollar risk will be $400. If you want to buy call it a contract, a stock, or whatever, not at $50, you analyze. The analysis says that the right place for your stop loss is $48. The risk per share or per contract will be $2. Using the formula, position size 400 divided by 2 per contract, $2 contract equals 200 shares, or again, it depends what you trade, future contract or stock or whatever you're not. By using this formula on every single trade, you make your risk call it constant. The dollar amount you stand to lose is always the same. Whenever you are stopped at 10 cents or you're even stopped at $10, always this transform risk management into a form of vague emotional guess into a cold hard mathematical clarity. This isn't its ultimate defense against blowing up your account. The third from this mistake is psychological train that directs your basically Rex follows the first two. Call it the downwards spiral of revenge trading. After you trade that huge soul-crushing loss from the FOMO trade or wide stopping gone wrong, your rational brain just shuts off. Of course, researchers show that financial losses trigger the same fear center in the brain as a psychological threat, which seriously impairs your ability to make rational decisions. You're not thinking about strategy anymore. You're just hurt and you're angry, and now you feel that so desperate. Bernie needs to take it and make it back right now. This is revenge trading. You throw your plan out the trash and jump into a low probability setup you normally never touch, and often you go even bigger trying to hit some run into instantly numb the pain that lasts from the loss. This is what's turning to bad day into ruin account. Basically, the first big loss was the trigger, but this string of impulsive, angry trades that follows are what really creates those 10K's weekly disasters. Each revenge trade just digs a hole deeper, which create more panic and mistakes, and psychologically impossible to stop. You're not in control anymore. You are fear. Your fear and your ego running the show. The solution is basically hardest one to follow, but it's the most important psychological discipline. You have to make a rule for yourself before this happens. This moment you feel that hot flashes of anger and desperation after a big loss, the best trade you can possibly make is to not trade at all. Close the platform and walk away. Have a hard, unbreakable rule. If you are in the max daily loss, even after a big loss and it gets emotional, you're done. You're done for the no exception. Go for a walk, hit the gym, do anything, but start at the chart, stare at the chart. You can only figure what's went wrong when you are calm and objective. Not them when you were in the heat of battle. Keep in trading journal where you is or a log, not just for your trades, but for your emotional, call it stability, and it's gonna be incredibly power tool for seeing the patterns before they're going over. So if a single mistake costs you thousands, and it's not more than like a big secret. Let's letting your emotion, fears missing out of and fear of being wrong hijack your brain and detect your risk management. It pops out of those oversized informal trade. It's this illusion of safety with poorly sized wide stops and deceptive spiritual revenge trading. And but the solution is basically just as clear. You have to shift your entire mindset. Stop acting like a gambler, hoping for jackpot, and start acting like a CEO of your own trading business. A business that have a plan, a business that managed by your money, a business that have a critical, strict control management. Your number of jobs. Call it your number of one job. Your number one job as a trader is not to be right at every time. It's impossible. Your job is to protect your capital. You do what you do what with non-negotiable trading plan is stick to it. Then talked about the 1-2% risk rule. Like life depends on it. You have to stick to like your life depends on it, and having emotional discipline to walk away when the things go south. This is how you stop bleeding. This is how you survive, and this is how training is becoming a victory, not survival mode. If you have this, if any of this hits you home, and if you have been caught up in a destructive cycle, do me a favor and leave a comment below. Tell me which one of those mistakes has cost you the most. You'll be surprised how many traders and how many people fighting the exact same battles. In reality, help us to know where we're at, and definitely that we are not alone. And if you're ready to stop guessing and finally put a real professional risk strategy in place, make sure to subscribe for more videos where we break these concepts down. For those of you who are that serious about turning this around, I also offer a free strategy session to help you build personalized a personalized plan. You can find the link in the bio, in the description. Of course, I want to thank you for watching, and I'm going to see you on the next one.